Well, good morning from San Francisco and good evening, wherever you are. We have folks joining from all over the world. And thank you everyone for signing in. My name is Unmesh Sheth, founder and CEO of SOPACT. Today, I have an opportunity to have an amazing uh, panel who will be talking about a very important topic on the role of impact verification in the impact investing. So thank you for joining today. And we know that many people are joining, but we will get, in fairness of time, we'll get started and start doing some introduction. So today I have a privilege to really invite authors of the book called Impact Investing. It just came out in the bookstore. So Paul Herman, many of you may know. Paul himself he's been known to a lot of people in many ways and practices altogether. Paul is a founder of HIP Investors, HIP Investors, commonly people say, or even sometimes people refer to as HIP Ratings. It's ratings for sustainable, profitable growth and lower future risk that can lower the risk for solving human and socio-economical needs altogether. HIP Investor licenses its 130,000 ratings and advises and manages sustainable portfolios and partners with the fund managers, RIAs, and wealth advisors to serve accredited institutional and everyday investors. Elsa, who also happened to be co-editor for this book. I'm so fortunate to have Elsa and Anna also joining today. They are very well-known, seasoned practitioners, and very fortunate that they are bringing the point of view of the impact measurement and verification from European area. And Elsa herself has a very deep, she's an economist and essentially she is focused on policy and research and impact evaluation. And Elsa has lectured into the academia since 1997 and associated researcher at the NOAA Africa. She was a Director General of the Research Officer at Portuguese Ministry of Economy and Innovation. Elsa has also worked for African Development Bank, World Bank, and European Union Millennium Challenge corporations, among several other international institutions in over 100 countries. Wow. Even I have not even reached 100 mark yet myself. She recently co-edited this book and also another chapter with Anna as well. So Anna is currently working on, so Anna Pimenta, she is a seasoned impact practitioner. Really, she has brought in her knowledge on working with the large global banks, Banco Santander, based in Madrid, in Spain altogether. And she's finishing her PhD in economics and business and about SDG-based framework for measuring impact investing. So we will have lots of experience coming from the field. And I'm so fortunate to have all of you here together. So welcome, Paul, welcome Elsa, and welcome Anna. You can say hi.
Thank you.
Hello.
Hi. Hello.
All right.
Great to be here.
So to get started, I will do a quick introduction about the topic today. So the topic is really the role of impact verification in the impact investing. So what the heck is impact verification? It's something that's quite misunderstood topic, but it's going to be also a very important topic going forward into the next decade altogether. As the impact investing is growing, the need for impact verification and doing the right way is going to be important. So let me set the base definition right. Let's say you are trying to create ecosystems of the agriculture in East Africa. And there's a large set of investors from European who wants to start the process on a very ecosystem and a very systematic way. Fundamentally, it requires that there is a good engagement process with respect to the community. Does community agree with the projects? Do they understand the risk of any projects on fertilizer risk or any other risk. If investors or entrepreneurs is reporting the results of a wage increase, does the stakeholders, farmers, agree with that thing as well? So all those things requires to managing different type of dimensions of impact, and that's where the impact verification comes in. Now, there are many definitions of impact verifications. Many of them think that simply aligning with impact IFC principle and SDG impact certification is the way to the impact verification. And it's true that it really helps you start the impact verification, but impact is all about impact management and capacity building altogether. So I know there are many definitions, and that's why I would like Elsa and Anna to pitch in and really give a very clear walkthrough of their definitions of impact. Just for everybody to know, and I'm going to quickly give it back to Anna and Elsa and Nepal, but fundamentally, we are, SOPAC is a series that you already know, many of them. It's a series that we started 2 years ago, and it's a series of conversations that started with the another author of this book, Jane and Veronica. We heard them about, they talked about standards and frameworks. Back December, it was an extremely popular webinar. And it's a series that we are starting for and continuing dialogue with the 60 Decibel, who talked about stakeholder voice and how to design stakeholder surveys in a very effective manner. We talked to Jamie a few months ago, who talked about who owns the rule or keys of the impact management. Exion presented stakeholder approach on a digital transformation. And today we'll be talking more about impact verification. Now, impact verification is still not been well thought through a complete process altogether. A lot of definitions are evolving. And the way we put this definition is that it really starts with the asset managers, accelerators, and program organizations who really systematically want to bring ecosystem change. But to bring the ecosystem change, they must work with their ecosystem of the investments or portfolio and ensure that they gradually help them grow them from starting to improving to growing to the scaling. When you reach the scaling phase, that's where impact verification comes in. And so if you look at the typical life cycle of any fund manager, they have funds, enterprises, there can be in any of these phases from starting to improving to growing to scaling. And the whole goal is to really bringing them all the way on the bottommost right-hand side quadrant altogether. The fact of the matter is many of them are still in this phase. And in fact, in the next webinar that I would like to invite you, and we'll also share the thing, we are very happy to invite Claudia, who is a CEO of a very well-known and very influential project in the impact management called Impact Alliance. She will present some of the techniques like impact classification from impact management project, which really helps investors classify their portfolio through different type of contribution, as well as the different quadrants of are they avoiding harm, benefiting stakeholders, or contributing the solutions. Again, it's all about essentially bringing investors' portfolio towards the right bottom side altogether. And it's very important that we really, as a community of the practitioners together, we work to achieve the better investments, and we work towards the better definition of the impact verification. So before I hand it over to Paul, Paul can start doing the introduction, but I have a question for you. Now that you heard what impact verification is, we'd like to do a very quick polling, and Hito can get started with you can just set the polling. So please, it's a very simple yes or no question. Do you think impact verification is about stakeholder? Okay, so thank you. Please keep voting, and Paul, thank you for your time. I'm so excited to be here. I mean, that you be here, and also bringing Elsa and Anna to this conversation, and to really drive this impact verification topics further. So please go ahead.
Thank you, Inbash, and thank you, Hetal, and good day to those of you in the Americas, Latin America, Caribbean, North America, and buenas tardes, and good afternoon in Europe and Africa, and good evening in Asia, including the Maldives. So I'm very excited that we have coverage globally. So impact happens all around the world all the time. Delighted that Elsa de Marais Sarmento is here. She and I co-edited the Global Handbook of Impact Investing, which she's been leading for several years to aggregate the latest innovations together. You can see the book here on screen. There's 6 parts to this book and 30 chapters. There's 6 chapters on impact measurement and management. So if you want to know some of the latest impact measurement and management, please consider buying the book. It's available in print, in ebook, and if you buy it from Wiley.com, there's even an audio version. Anna Pimenta is an expert in impact measurement and management, and so she and Elsa have co-authored in-depth review of a wide variety and spectrum of the impact measurement systems that can be used. So it's a great resource. Some people call this book, because it's 1,300 pages, it's bigger than War and Peace. I promise you there's more peace than war in it. And some people call it the physician's desk reference for impact and impact investing. And so whether you are covering climate or the Sustainable Development Goals or IRIS and the GIIN, there's lots in here for you. And the introduction to the book is by Justin Rockefeller, who is an impact investor himself. So Anna and Elsa are going to lead the conversation, and I'll come back later in the conversation. But just want to thank everybody for being here. Thank you, Inmesh and Hetal and the SOPAC community. And as you know, this is being live and recorded, so please feel free to share this with your networks and community. Elsa and Anna, over to you.
Yeah, thank you, Paul. Hi, everyone. So we decided to start explaining why we are here. So what can we expect from today's session? No? One of our goals is to promote impact measurement in management practices, so better impact measurement, and also to increase the sophistication of measurement, and clarify what is impact verification. Although Amesh started to talk about it, I think we can go further and explore the concept much more, and talk about its importance and how it works. And as an ultimate goal for us on this webinar was to try and help to avoid what is normally called as impact washing. So today we decided to organize the presentation in 3 parts. The first one will be about the concept of impact verification and why it is important. The second one will be focused on how to do impact verification. And the last part we'll talk about some real case studies. So what is impact verification and why it is important? It all starts with the concept of impact investing, because this is impact verification for impact investing purpose, which, as you may know, implies intention, contribution, and measurement. So the goal is to focus on the right results. As you can see, sometimes we are talking about different things, and the concepts can be confused. No? One person is talking about 1 million of views, and another one in a very specific concept of impact, how many children we save. No? And sometimes it seems we are talking about the same thing, and we are not. What is the difference between an investment with impact and an impact investment, because they are different. The difference is mainly on intentionality. So an impact investing brings intentionality, it needs intentionality, and investing with impact is more related with generating impact, social or environmental, while we are pursuing our activities. So there are three important concepts on this area. One is impact measurement, another impact management, and finally impact verification and auditing. So these three concepts are connected, of course. They should coexist, but they are different. So impact measurement is much more connected with measuring the results in the end of the project. Management has much more to do with incorporating the measurement procedures and the insights of measurement during all the process of the investment life cycle. And finally, the verification and auditing as a way of confirming, of checking all the results we got during the measurement and management process. DVPA also considers these five steps of the social impact measurement process. First one, setting objectives. Second, analyzing stakeholders, which is very related with the AMESH question in the beginning. Third, measuring results. Fourth, verifying and valuing impact. And finally, monitoring and reporting. This is also included in all the full spectrum of investment process. So from the beginning until the end, we should incorporate the measurement, the management, and the verification process. Particularly since the due diligence phase until the exit phase, everything should be measured, confirmed, analyzed, and if possible, in the end, verified by a third party. Elsa.
I'm going to step in here. Just to say that sorry, I'm having these messages popping into the screen. To say that without an external or let's say an independent assessment, it is much harder to actually verify the source of an eventual problem or lack of impact or just below the expected target. So a lot of institutions then starts what it's called the wheel of blame, and they do not clearly understand where the problem lies. So one of the goals also of having impact verification, which of course has different, let's say, shades of gray, but if we want to be more stringent, right, like audit, evaluation, which is also let's say a broader type of assessment of impact, needs to be done externally. So anything that is done internally in the business, in an impact investor, in an organization, is an internal assessment. And we know that internal assessments have bias because we are assessing each other, right? And we are always biased because we have an idea about our level of effort, and very often we think that we've done everything, or our team has done everything that was possible to achieve those goals, those results, and sometimes we are missing key issues along that way. So we have, and this can originate, loads of different issues, and I think the next slide is due. So, we are not very good at admitting internally our mistakes. We often do not document also the process enough in order to really see, where is the lack of progress, where is the lack of performance. There are, more serious issues, and we can go on and make the same mistakes. Often there are problems with the management also. So this gets a very complicated, entangled process that does not really help what we call a results-based management process. So let me just clarify a bit, because I think sometimes in this area we are lost in terminology, and we are indeed, and even for the people who work in this area, we traditionally call, impact, the long-term effects or the long-term results of an intervention. It can be a project, it can be an impact investment, and below the impact, that is in the medium term, you have outcomes, and in the short term, you have outputs. So you start with the activities, you go on into the most immediate effects, which are the outputs, to outcomes, and finally impacts. So impacts refer to measurements of, long-term effects, because it is the ultimate desire or intended effect of an intervention. Verification is really something that exists broadly in what is called the evaluation world. And one of the things that we tried to get or combine in the chapter that myself and Anna have written, which is chapter 16 of the book, which is called Measuring and Evaluating Social Impact, Investing in Impact Investing, an overview of the main available standards and methods. We try to combine in here, without going much in depth into experimental and post-experimental methods, and I will explain later what these are. But let's say the first set of, or the most used set of, or let's say the most common set of methods and standards that you can apply to really assess the performance of an impact investing project. So no matter let's say the mechanisms to assess results and impacts that we have internally, this will only be credible and validated if it is done like auditing by an external auditor or assessed by evaluation. Evaluation is broader in the sense that it is not constrained to accountancy or administrative processes. Evaluation goes on to looking at the social and environmental goals of that project, and which is what defines impact investment. As Anna explained, is intentionality to produce beyond financial returns, also social and environmental returns, and corresponds to the achievement of longer term results. So why verification? Because this serves to really provide information. It's a learning process to improve the implementation and effectiveness of the project. So it's the effectiveness side, but it also works to improve efficiency, how to better manage limited resources. Then it serves to demonstrate how performance or non-performance that impact investing project has been. Also to document, so we are looking for evidence-based proofs of what has happened. And of course, the results of that reporting and that analysis serves to justify investments, additional fundings, or also to close a project. And of course, helps to think about successful replication. So there are lessons learned from the process. I think you can move on. Right, so sorry, I'm at the previous slide. So indeed, the reality is that most, I would say, at least in the initial stages of the learning process, most still do these or implement these sort of processes because they are obliged to. They have an external pressure, either from the investor, from the funder, that makes them have to set up these reporting and measurement schemes. They do it also to justify the existence of the project, or sometimes even to end the project. You can commission audits and evaluations. But the fundamental idea here is a focus. The accountability is there, of course, but the focus is on the learning by experience to make better decisions. And we should move on. That's why the line is there. So this independent verification is usually carried out, as I've said, by an external team or external evaluator or external auditor, but has, depending on the context, can be quite stringent. right? It can be there in certain instances where that external party needs to comply with the absence of conflicts of interests, where they need, if they have access to confidential information or microdata, they have to sign a confidentiality statement. They have to know how to deal with statistical confidentiality. And of course, they need to respect ethical principles, which for me is really the key issue in doing any of this assessment, is to maintain the guiding principles of ethics. And this requires training and really in-depth study and also practice, because we encounter sometimes issues of lack of good governance, and we need to take decisions about what we're going to do, what we're going to expose, how we are going to do it, in order to really have an effect and try to change the process. So this requires thoughtful thinking about how we're going to tackle with that situation. I'm just providing you a few examples, but there are several examples of guiding principles and ethical principles, especially in evaluation, which is a broader area where this all fits in. Impact verification, auditing has already specific and stringent rules, and even to become a qualified auditor, you have to go through a specific process and you have to be certified. But within evaluation, you also have guiding principles at the American Evaluation Association, for instance, the Canadian, the European Evaluation Society is now working on ethical tips. And there are other guidelines, for instance, in the UK, in the Commonwealth, and any third party that is doing an assessment of another institution or organization needs to critically consider its behavior and have an ethical practice of non-discriminatory behavior, and also, of course, be inclusive, and in particular of the most vulnerable. And we're talking about impact investing. So we're trying, we have these investments that have, longer term goals that intend to have social or produce social change. So very often this social change has to do with vulnerable groups, marginalized groups, and we need to know where we need to go to get their view and their feedback in order for all the assessment to be credible. Right, so these are just some of the principles that we have to take into account: integrity and honesty, impartiality, respect for people, for public welfare. I think we can move on. Just a few things. So beyond that, we need to be technical and to know what we are onto and have the technical requirements to do it. Systematic inquiry is one of them. We need to be competent in our field of work of where we are going to do that assessment in the theme, in the area of where the impact investment is operating on. And of course, confidentiality was already mentioned. We can move on. Right, yeah, so these are just some of the principles. There are several, and in order to practice this confidently, you need to be very familiar with what this means in order to produce an independent assessment that is also well accepted by the party that you are verifying or evaluating. Go ahead. Right. There are also the OECD and European Union, namely, they have specific requirements for evaluators, what you need to have. So this is not just all overall principles, but for the person that is doing this work, you need to have this set of qualities and you need to work on those. Right. So the ambition of impact verification, as we have mentioned already, has to do with accountability, and mainly accountability and learning. Usually these are the two main guidelines. I think that we are all trying to work more on the learning side, because that's where we can move on and produce better projects, better investments, and also greater impacts. But this also implies transparency in the way that we behave, and transparency in the way that information is produced and dealt with, but also producing systems that are there from the start. And I think, to me, impact verification is embedded in every stage since the beginning of the whole process, and since the moment that you start with the baseline, you're already considering some form of internal impact verification. So we're talking about implementing systems, structures, frameworks, that relate to results-based management, because this is what we're talking about. We're talking about impact, which is a long-term result. So we need to think about the structures that will ease our work, because otherwise we will be losing a lot of time just, you know, with the constant monitoring or measurement process. Yeah, so this is basically what we seek with results-based management frameworks and structures, where the methods are integrated, where, you know, we have indicators, you have people, you have processes, you have structures, and you want to learn what is going on, what is failing, why, who is accountable for that, but above all, you want to learn and to improve with the process. Right, so this is something that I think we need to distinguish here also, and we'll come back to this. It's about the difference between contribution and attribution, which is, you know, two very different words. And when we speak about impact evaluation, which, by the way, is different from evaluation of impact, we need to distinguish whether we are looking at the way an impact investment project has been contributing to a goal, in the sense that I've been working towards a result, but the ultimate proof, because imagine you want to decrease poverty, right? This is a very far-fetched goal. There are several things that have been working around there. So you cannot really take other external factors, even those, you know, those families that have been receiving no support. They might have been receiving support from other people, or since COVID hit, you know, the situation has completely changed, and only by this external factor, these families have been affected. So you cannot take out all the external factors that have been influencing those results. So the results can be negative, even if your project has been positive, and you cannot really disentangle if you're just looking from a contribution perspective, right? So attribution is different, because you're seeking, it's the other way around, where you're seeking the exact amount of impact that you can connect to your project. So we apply very different methods. These are called post-experimental or experimental methods. The state-of-the-art are RCTs, which are randomized controlled trials, which is what you do, for instance, when you're testing a COVID vaccine. You have a treatment group and a control group. One takes the vaccine, the other one takes a placebo, and then you test statistically to see whether they are statistically similar, and then at the end you compare results. Then you have a measurement of attribution, and these methods are completely different. And this is really true impact verification. This is the golden standard, but we do not apply it constantly because of several reasons, because of the time and the cost and the effort that is involved. So we can think also of a range of methods that we can apply into impact verification, also because of triangulation, because we need to validate results. Right, so I think I've gone through this. We can move on.
Okay, so in the end of all of the impact evaluation process, and to distinguish a bit the last part of the process, we talk about impact auditing. That in the end is a way of assessing if all the measurement, management, all the evaluation process was done correctly, and if possible, done by an independent third party, similarly to auditing finance, for example. The goal is to determine if all the practice, all the data, all the information that is being reported is in line with the industry best practice, with existing benchmarks, and also with existing standards and methodologies to measure and evaluate impact. This is not a new field. It has been done since the 50s, but it is true that it has been more sophisticated and more used nowadays. So the key principles of auditing impact are to include everyone, so multi-perspective, to include all the activities, so being comprehensive, to be as much as possible comparative, so for the same issue at least that we can compare, particularly, for example, between different years, it should be done regularly and, if possible, more than once in a year. No? It should be assured or verified, again, the same word, by a third party. And finally, it should be disclosed, which is related with, for example, publishing an annual report on sustainability or non-financial reporting, for example. GIIN has in their report about the state of impact measurement and management practice in last year, verify that almost 90% of impact investors see transparency on impact performance a challenge. And also about 85% think the integration of impact with financial management decisions is key. So why is this important? Because understanding the contribution or attribution and validating it is key. We need to identify the impacts with the highest social value to make better portfolio allocations in impact investing. It is also important to ensure that activities, impact activities, and all the company activities are aligned with the mission and strategy of the organization. Impact auditing also helps to support and improve decisions, because if the numbers are right, we are making better decisions. And in the end, it strengthens the transparency, the credibility, accountability. So the main goal to get more capital into the impact investing industry. And more recently, technology has been helping to improve this process through big data, predictive data, is increasing the quality and the quantity of data and information regarding social and environmental issues. And also in real time. So nowadays, a lot of platforms and tools and the way we are connected allow to have data in real time, which is very important to make decisions as they go, right? And of course, everything technology is helping to create more cost-effective studies, and this makes that more impact studies are being done, so everyone can use them, because in the end it is easier to share also, because of technology also is helping to share and compare things. Now everyone can assess things, everyone can use benchmarks from different sources, different studies, research. So it's helping on that, on these main areas. And impact auditing and verification is in fact a new service for a lot of different organizations, particularly auditing companies, as you can see here, and consulting companies also, and requested by distinct organizations. So for example, we have financial companies, B Corp companies, oil and gas, tech companies. No, all of them are publishing and talking about the non-financial reporting, sustainability reporting, how we can be responsible, all of these topics. No?
And Anna, this is, if you could just go back for 1 second, this is a really interesting mix of reporters. Certainly somebody like Google is trying to make the intensive energy usage of data centers, which is all measurable and potentially, verifiable, including by the consultant auditors you mentioned, like Deloitte or PwC. But then there's, you have somebody like Shell, Royal Dutch Shell, and when you read this responsible energy report, one of the items says, "We'll reduce our greenhouse gases in line with society." So there's sort of a slight hedge or ambiguity. And obviously the business model is built on being extractive, but there's some quirks like that. So have you had any observations of how specific those measures can be, and are there things like sensors that are starting to used as verification? So, just like the weather has sensors, are there sensors for pollution or water pollution or air emissions?
Yes, so companies, all companies, not just the big ones we are seeing here, because these are more, everyone sees that, no? But also small companies are seeing this. They use a variety of frameworks that is incredible. So this is just some examples, but companies can use ratings, they can use principles, they also use indexes and standards to report all the impact that they are creating, from sustainable impact, like Paul was saying about water and the energy, things like that, but also things regarding with social impact, more connected with the so our employees, the way we impact our society in terms of humanity, no, in terms of people too. Not just our employees, so internal impact, but also externally, no, how our organization impacts the society and the world we live in. And I think Elsa is going to talk now about how impact verification should be done.
Yeah, can we take a pause though? There's lots of interesting questions in the question and answer box.
Yep.
If there's any of those that, there's several about like scarce data, and certainly like being in the social sphere. Like, how do you measure changes in people or changes in well-being? Like health outcomes might be more definable through testing, but what about like emotional well-being? Are there verification methods for people's emotions or satisfactions or feelings?
Yes, that's a good question. I just talked about that in my master's classes last week. They were also worried with how to measure these intangible feelings, no, and sensations. So yes, there are some frameworks regarding, for example, happiness, well-being. Yeah, these are the most famous ones. For example, OECD has one for happiness. Well-being, there are 2 or 3 also very famous. The thing is that there's no one framework, there's no one common framework, but they can be measured, particularly considering the ways people think. It is still very focused on how people think they are happy. So in self-assessment assessments, no? But it exists, and benchmarks also exist for most of the countries. So you can also compare if people in Spain are more happy than people in India, for example, and you can have a benchmark of that.
Great. And what about scarce data? What is the solution for scarce data? Because when you look at the Sustainable Development Goals, there's 17 Sustainable Development Goals. There's 169 or so targets. They might be expanding, which are like the metrics. But data isn't available for half of those today. So the metric has been designed, but the data is not available. So are there strategies for that? How to do any form of verification on data that may not exist?
Yeah, I mean, I think the lack of data is one of the most, one of the concerns worldwide, particularly even for these more intangible issues, and less developed countries also do not have a lot of data or quality data also. That is important. We can have data, but we can have data that is not that does not have a lot of quality. I think I always say that there's more data than people think. I mean, when I started to do a lot measurement I work a lot in education. That is an area that is difficult to measure because it's so long-term that you can see the effects. And I start thinking there was no data or very small data. And I work for Latin America countries too. And then I started finding a lot of information that I didn't know exists. So I always say the same, before saying there's no data to do it, please look, because there's a lot of data. Even if you can't find it exactly on that target of the SDGs, a lot of data for the targets exist, even if it's not in the website of the SDGs, but it's in other websites. So I didn't find difficult to find a lot of data, but to organize the data and work with the existing data, I think it's the main problem.
If I can add to that, well, it depends where you are working. Even for developed countries, they don't have data for around half of the SDGs, as Paul mentioned. I'm thinking about that. We have people from the Caribbean and probably from other small island developing states. I'm currently working on it. I remember for the Organization of Eastern Caribbean States, for instance, I had to measure something, and going back to the first question about measuring sometimes that the things that are considered intangible, I had to measure regional ownership and good governance of a process of regional integration within 9 countries in the Caribbean, right? How do you do it? So the first thing is you define the boundaries of you want to measure. And this is really key for anything that you do, and also for what we're talking about, impact verification. You need to know exactly what you're measuring. So for instance, what I did was I got approved by the 9 countries what a definition of good governance within the regional monitoring, economic and monetary integration within the OECS, and the same for regional ownership. And then you design, if the data does not exist, which was the case, you design data collection instruments. So I designed surveys, and you have to think about all the process of how you're going to collect that information, but also at the very end, the kind of reporting and the users of that information. So you have to have the whole system complete. In the case of small island developing states, for instance, and in the case of developing economies, it is really a fact that there is no data, official data. Sometimes you have to look into less known sources, research institutes, papers that have collected or amassed a database that can be shared. So some information exists. You need to know where to look for. A lot of is in academic research projects. But also you can get a lot of data and significant data, because some official statistical indicators come from those also. You can collect from administrative data. So you can create indicators and match those with SDGs, if not completely, at least to create proxies, and you can match those with the required data. So again, you have to devise the data collection methods and the indicators, and you really need to have a very good view of what you're going to need to report at the end and for whom, because that determines what you're going to measure in the first place.
And so what's the role of asset manager in creating the data culture for this enterprise? Because ultimately, enterprises are connected to the stakeholders. But when we talk about impact investing, what role the asset manager should be playing in creating data culture? Because if enterprise don't have data, what can they do?
Yeah, that's a great question. I'm happy to jump in there. And Anna, I think there's a slide in the case study section that has green, yellow, red on it. And what's very interesting is, a couple more, keep going. What's very interesting is that the, one more and another, okay, right there. So if you just back up. So with the green, yellow, red on the slide, if you back up one slide, is there's what we want to have. This is on the right-hand side, what we want to have. That red bar, looking at companies, is material information that's not disclosed. And this is of the Standard & Poor's 500, so the 500 largest companies in the US. When you look around the globe, it could be higher or could be lower, but generally anywhere from 25% to as high as 50% of information that we want as investors is missing. It could be around planet, energy, water, waste, emissions. It could be around people, employee satisfaction. What's the proportion of women working in the company who are leaders or innovators? The company knows that, but they may not reveal that. And then even information about trust and governance. So there is a gap today. And so there's I would say, an emerging competition of who can be the most transparent. So this year in investing, for some reason, now net zero has become, everybody wants to do net zero emissions. And net zero emissions is not zero emissions, let's be clear. Net zero emissions is, can I plant some trees or do some projects to offset my emissions? And for software companies like Intuit, who are starting down, have made some very aggressive commitments to reduce their emissions 50 times more than just their own emissions to cover their customers. Or Microsoft and now Google have said, we're going to offset all our emissions back to our beginning of our company in the past 20 or 30 years. But this gap, this red gap of transparency is a large gap. So this is where, as investors, as citizens, as stakeholders, there were some questions in the chat about who should be responsible for this. And the reality, like Anna shared and Elsa acknowledged, is some is going to come from the company. Some can come from nonprofits. There's nonprofits that track, especially environmental measures. Some are going to come from multilateral agencies, including United Nations, helping aggregate the well-being, like in the United Nations Human Development Index. Some are from for-profit companies. So there's a company called Glassdoor that asks about employees and collects information from employees. The Great Place to Work Institute is another one that surveys employees. So right now there's an upper limit for some organizations, and they may vary by country and by size. There are mandated disclosures from everywhere from Japan and Korea and Singapore and Hong Kong, where there does tend to be higher disclosure. The stock exchange and the expectation is higher. But in markets like Thailand or Indonesia, or in even in Brazil and Argentina, there's lesser disclosure. So we can't have highest performance and highest accountability without transparency. And so I think that's this is a very important point. So I think the pressure is going up as dollars are being allocated to impact and ESG and sustainable investing. That pressure is going up to disclose, and then the pressure will be higher to perform, and then we'll have the highest possible pressure on accountability.
Okay.
But I'll pause.
Thanks, Paul. I think I'm doing a time check. By the way, just to everyone, we are prepared to go further than this hour for a maximum 15 minutes. And after that, we'll have a very sharp, I know that there's a lot to cover and there's a lot of questions. So Anna, Elsa, please answer. There are more than 32 questions which are open. So we'll keep this time open for some quick Q&A. But till then, at least maybe if Elsa or Anna, you want to complete at least your presentation by 10 o'clock, just 7 minutes. And then we can take the rest of the time on Q&A because there's still lots of questions we can cover, which could be quite exciting. Elsa, you want to go forward, or Anna?
You mean answering some of the questions?
No, just I think we're going to continue with the presentation, right?
It's fine. Okay, we can go very quickly through the slide just to provide an overview. Right.
How?
We can move on, Anna, I think. Move on. Right. No, before. No, right at the start, at the how part. Okay, now we go. Yeah, the following one. All right. So we had a lot to discuss here because we're getting into the more technical part, but we'll just provide a very, very brief overview. The how you do it. So we have this whole chapter that that provides the guidance about what is out there, the standards, the methods, and also how to apply it depending on who you are. If you are an investee or an investor at different stages of maturity, and for particular situations, cases, areas, also issues. So you have to tailor-make. You have to look at the different methods that are out there according to your exact circumstance. This all happens to me. It all starts at the very beginning, when you start the monitoring, when you start the baselines, when you start accounting, right? You need to think about impact verification. One of the questions was, by the way, was, should impact be looked at incrementally or at the very end? Again, this has to be considered right at the beginning, because if you're taking it internally, how you are going to do it as an impact investor, as a business, right? In which types of moments you want to have a sense of how well you're doing. So you take a monitoring instrument, it can be monthly, it can be quarterly, it can be daily, real time, and you know how you're doing. But you can commission because one thing is the monitoring, you set indicators and look at indicators throughout time. The other thing is you do a more in-depth assessment, and then you can have a midterm evaluation, or you can have evaluations each year as the project goes by, or you can have also but usually you have one at the very end, because that's when you want to assess the overall performance, right? But beyond looking at the very end, you need to establish from the outset, or you should, because otherwise you're going to have more costs because you did not set up the right structures to do these measurements, right? So you should from the outset think, what are the instruments that I will be using and the moments at which I am going to measure my performance, my results. Of course, if you have a 10-year or even less, a 5-year project, and you're doing a measurement at the end of the first year, you are not measuring an impact because you have not yet gotten there. You're probably measuring activities, looking at activities if they were done, and looking at the first set of outputs that are materializing. And if you correctly design a theory of change, which is the basics of measuring impact, because you need to understand the underlying impact pathways, the mechanism at which you can work on climate change, the mechanism at which you are working towards developing the private sector, or increasing the country's GDP, or just helping out in a certain region, improving poverty. So, but you need to know how your project, how your specific mechanism connects to the big picture of the impact that you want to contribute to. And then you have to look at the mechanism and measure it throughout, because you cannot measure it only the beginning and the end. So you need to establish instruments that follow, right? That is monitoring, and you can use verification at any point in time that you want, internally or externally. Externally, you know that you have a confirmation or not of your internal validation, and you can use it to attract more funding, to become more credible, to your investors or to your market, right? But you need, and this slide is about, getting the right resources and the right sort of knowledge into that mechanism. We can go ahead. Yeah, we're almost done with the time. And now let's move on with the slides. Yeah. Again. So with the iris, we are defining right at the beginning the metrics and all this framework for measurement, right? Okay, we can move on. So the theory of change is a very key part in all this process. We can move on. And I think we are out of time. Right, so I had here, something to say about what critical components have to be there. There needs to be demand. You should create it internally, or otherwise you'll have it externally, but good practices say that you need to think about your results-based management practices and adopt, hopefully, international good practices in terms of measurement and impact verification. But we have also a set of incentives, like standards, and sometimes you have to comply with certain standards and report, for instance, using IMP standards. But you also need to establish within your company or within your business clear roles and responsibilities, who is going to do what at what point in time, and make sure that the information that comes out is credible and reliable. We have spoken already about the issue of accountability, so I think I can conclude right here. Anna, do you have anything to add? Paul?
No, there's nothing to add here. If we just pull up the slide, I think it's the Sustainable Development Goals slide. It's a couple slides into section 3 in the case studies. There's a question about, one more, right there. There's a question about, 1, let's talk about Sustainable Development Goals, but 2, like what are organizations doing? I love this example because it's the intent to say we're doing everything. So General Motors is a car company. They make Cadillacs and Buicks and Pontiacs and the like. And their sustainability report, it's quite amazing, is several hundred pages. So they've mapped metrics to the Global Reporting Initiative, to the SASB, Sustainable Accounting Standards Board framework, here to the Sustainable Development Goals. Don't worry, we're doing everything. And I think this is a great case study for verification. Like, what are you doing? Why are you doing it? And it's not, for a super large company, I'm sure there is positive progress in all of these, but it doesn't show focus. And there's a question that you can ask as a reader is, which of these are just stories or anecdotes? And it's great to see that maybe employees are mobilized throughout the company. But like, what's the focus? And so for a company like General Motors, which is probably moving towards electric vehicles and has redone their logo now to have a little plug in the logo and to make it look silvery and electric. The amount of greenhouse gases that they emit from sourcing the metals and earths, forging the cars, producing the internal combustion engine, and then the whole flow of carbon emissions and other emissions after that. That should be their number one focus right now, how to drop their carbon footprint, because it's one of the top in the world. They're responsible for that whole ecosystem. And certainly when tires shed rubber and it flows into the water, that's a factor too. But the environmental footprint, the total environmental footprint, really is the number one thing that they should focus on. So I just want to point that out, not only from a verification perspective, like how could you verify all of this? So I've heard some accounting and auditing firms are willing to do these environmental audits or SDG audits for free to get the experience, to maintain the relationship. And so if you're in charge of that at your company or your organization, you should ask for that. Say, can you do the first one for free? We'll pay you for the second one. Or you could say, can we do it at cost? Or you could just say, let's do it. That was one of the questions in the chat was, who pays for it? And so while the company or the organization may hire the consultant to do that, or in some cases, outside stakeholders may hire an auditor to do that, either the customer ends up paying for it in prices or the investor pays for it. And the more specialized, usually the investors will pick up. There's a lot of foundations that will pay for impact reports. And so think about who it lines up with the mission, and whoever wants that accomplishment in the mission is usually where it gets paid for.
So I'd like to ask this question to any panel here, which is really, and this is something came out with the Jamie Nichols panel, which is really, there's a question about paying and aligning the SDG and all those things, great. But one of the biggest concern and most of the confusion comes in is, how am I really aligning with the SDG? And how do I know that I'm tracking towards the SDG at all? So I think maybe, Anna, you can answer, or is it important to report like what you just see on the screen on a SDG thing, or is it more important to have a system where we track the internal target and present positive and negative impact? What is the right approach, and how would you advise organizations to do right way?
If Anna doesn't mind, I'll go first because I think I'll be shorter and she can complement. What we see these days mostly is organizations reporting on exactly what is this, right? They add these colorful boxes to their reports because they just relate thematically. So it's just a bunch of good intentions in there, but most of it is not tracked, is not measured, and probably doesn't even make sense because these are so high level goals, that specific projects, we cannot really grasp how much they will contribute to, to such a macro level goals. Now, what is being done at this point in time, and also responding to one of the questions that we received, which was, is there an acceptable impact verification methodology for SDGs? Does a nation's performance on sustainability index on the SDGs bring any normalization? Right. So what we see and what we have these days, and the initiatives like of Paris 21 with developing countries and initiatives that we see in working groups at OECD, the European Union, and so on, are statistical offices. Official statistics are working on integrating the indicators, because we're here seeing only the goals, right? But below the goals, we have a set of more than 100 indicators, and those are the ones that are actually used, indicators and sub-indicators. And at that level is where the measurement happens. And those sub-indicators are the ones that are being used by statistical officers to report to these goals, because now the mandate towards the UN is that countries are compelled to report to SDGs. Actually, now there is a big trend to develop national monitoring and evaluation systems from their national planning systems that are fully aligned with the SDG, because they need to report. So this is about statistical offices and official statistics. And the moment that they can comply with these indicators, we will have not only the indicators to feed into what we see in here, and to have, to have a sense of how they are performing individually at the country level, but also to benchmark. But once we have the country data, we can have a single project get that country data and try then to with more specific methodologies to assess what is that single project contribution, which might be very small and impacting 100 families, impacting within a single region or a certain team or a country, right? So this is something that is undergoing, and we should keep in mind the work of statistical offices in this regard.
Emma, you want to add to that?
Just to add that, I think the question was a lot focused on companies, how we can use the SDGs for reporting purpose also. And I think, like Elsa was saying, there's a lot of government, public data, all of these. But also my recommendation, or what I usually do for reporting purpose, for metrics and these kind of things, I try to not create everything from scratch. It is another advice for you. So there's a lot of even indicators on the SDGs. There's also Iris Plus, for example, that there's a lot of indicators that cross with the SDGs. So you can also specifically focus in the SDGs you want. And always, like also Paul said, it's important to not have all the SDGs, so we can have impact everywhere, but I always try to focus on the 2 or 3 things that I want to do and I want to measure and I want to focus. Otherwise, it will be chaotic when you focus in 15 SDGs, because the importance or the materiality you are changing will not matter a lot. So try to focus on the essential and choose, if possible, existing indicators and metrics.
So Paul, next time I see this kind of report, I would probably throw in a dustbin and say, whoever did it, doing SDG washing. Is that the sentiment?
Well, no, don't put it in the dustbin. Get people visible and say, please tell us, what is the materiality of this? So there's different versions of this type of chart called a materiality matrix. And for those of you who know about SASB, Sustainability Accounting Standards Board, they have a materiality grid. And so you can go to materiality.sasb.org. If somebody's putting effort into reporting, we don't need to dustbin it, but we do need to have a conversation and engagement around it. And that's like, what is the most important? Or one of the before this book, my first book was called The Hip Investor, how companies can do good and do well together. And there's 5 management practices. And one of those is the vision of the company to actually make the world better. Now, this has started spreading so much that some impact washing is, there's a rural telecom company in the US whose mission is now to advance human progress. That is not what this company does. It could lead to that. It could contribute to that, but they're a rural telecom company. And so the important things are there criteria like environmental or people criteria in how future projects are selected? And one of those is the cost of carbon. And so are oil companies like Shell and Exxon, are they rejecting projects because the future carbon is too much? Shell says they're doing some of that. Obviously, they're not doing it in a transformational way yet. They might be doing it in an incremental way. So it's whenever it's just we keep have to increasing the accountability, and it's a lifetime work. Everybody on this call, there's going to be a lifetime of work for us to improve the world. There's always things that can be better, but there's a lot of dramatic gaps that need to be closed now.
Great. So with that, I will probably like to try to wrap up. I know there's a tremendous interest in this topic, like any other ones. As you can see, there are so many complex issues, and we don't promise that we have addressed every question, and it doesn't mean that we are not. In fact, please look out for a SOPAC YouTube channel. We'll be answering all those questions through YouTube in our coming months on a daily basis, essentially. Idea is to keep this conversation going. So if I may, if you can stop sharing, I'll share the final thoughts on the webinar. So as you may all know, again, this is a conversation journey, guys. And SOPAC is really just a catalyst in bringing this kind of dialogue and the information. I would highly recommend you go out to SOPAC website and look at some of the past wonderful webinars from Jeremy Nichols to Emma to the Lindsay from 60 Decibel, Jane and Veronica, and so many other good, well thought through webinars. These are not easy topics, essentially. But these are the thought leaders who are really driving these conversations, and this is a conversation that will continue. And we hope that you will continue to participate in these conversations. There are a lot of channels that you can come and join on a LinkedIn and many other ways where we can continue to converse. And if you have any questions, please reach out to us directly